Hello, students, and welcome to the ACE Archive. I am so incredibly thrilled to have you here today. In this explainer, we're going straight into a super important part of your Class 12 Business Studies curriculum. We're talking about financial management, and specifically, we're going to master fixed capital and working capital. And we're not just going to read definitions. We're going to break these down using some fantastic real-world Indian business examples so you can actually visualize how these concepts work out there in the real world. So grab your notebooks, get comfortable, and let's get ready to learn. Here is our quick roadmap for today. We are going to cover an introduction to capital, the essentials of fixed capital, working capital and its formulas, the factors affecting working capital, and then a final revision to lock it all in. By the end of this explainer, you'll be totally ready to tackle these concepts on your CBSE board exams.
All right, Section 1, Introduction to Capital.
Okay, let's dive into this. Every single business, whether it's the little corner store down your street or a massive multinational corporation, needs a constant flow of money. It needs it to start, it needs it to operate daily, and it needs it to expand. This financial lifeblood is what we call capital. Think of a vibrant plant growing right out of a stack of coins. Money is literally the soil that fuels a business. But a plant needs different things to survive, right? It needs deep, strong roots for structural stability, and that represents our fixed capital. But it also needs daily water and sunlight to keep its leaves green and growing, and that is our working capital. Let's look a little closer at that first one.
Section 2. Fixed Capital Essentials. When you think of fixed capital, I want you to picture the very backbone of a business. This is where the heavy lifting happens. It's the money invested in long-term assets. We're talking about purchasing land, constructing giant factory buildings, buying heavy machinery, and securing transport vehicles. The absolutely crucial point here is that this money is locked in for a very long time. I mean, you can't easily sell a massive factory building tomorrow morning if you suddenly realize you need some quick cash. It's a major long-term commitment. So how does a business actually know how much fixed capital it needs? Well, there are 8 major factors you've got to know for your exams. Our first factor is the nature of the business itself. Imagine a massive manufacturing firm like Tata Motors. They inherently need an enormous factory, heavy assembly line equipment, and huge plots of land. Now contrast that with a simple retail clothing shop that just needs a small rented space and a few display racks. A manufacturing concern naturally demands far more fixed capital than a retail business.
Then we have Factor 2, the scale of operations. Think of a giant enterprise like Reliance Industries. Because they operate on such a massive national and global scale, their requirement for fixed capital is just astronomically high. Compare that to a small-scale local tailoring workshop operating out of a single room with a couple of sewing machines. The larger your scale, the bigger your fixed capital needs. It's as simple as that.
Factor number 3 is the choice of technique. If a company, say Maruti Suzuki, chooses a highly mechanized, capital-intensive technique of production, we're talking advanced robotics and automated assembly lines, they're going to need enormous fixed capital. Conversely, if a business uses a labor-intensive technique that relies mostly on manual workers, their fixed capital requirement drops significantly.
Next up is technology upgradation. We all know some industries change at lightning speed, right? Think about telecom and IT companies. The expensive equipment they use today might be completely obsolete in just 2 or 3 years. Because their assets become outdated so incredibly fast, they require frequent and very expensive replacements. So industries prone to rapid technological changes need way higher fixed capital just to stay competitive.
All right, Factor 5 focuses on growth prospects. Consider a company like Adani Green Energy. They have incredibly aggressive expansion plans for the future. Companies that are on a steep growth trajectory inherently need to continuously invest higher amounts into fixed capital to build out new infrastructure and support all that anticipated expansion.
Factor 6 is diversification. Now, what's really interesting about this is what happens when a company branches out into entirely new products. A brilliant example here is ITC. They traditionally dealt in FMCG and tobacco. But when they diversified into making classmate notebooks, they couldn't just use their old cigarette machines, right? They had to build entirely new manufacturing facilities from scratch. So diversification leads to a sudden, high requirement for new fixed capital.
Factor 7 is the method of acquiring assets. Let's say you're an airline like Indigo. Airplanes are unbelievably expensive. If Indigo had to buy every single aircraft outright with cash, the fixed capital needed would be unimaginable. Instead, they often lease their aircraft. Choosing to lease an asset drastically reduces the immediate fixed capital investment required compared to just purchasing it up front.
And this brings us to our final point for fixed capital: collaboration. Setting up an entire network of ATMs is terribly expensive for one small bank. But when cooperative banks collaborate to share ATM facilities with larger scheduled banks, they essentially share the cost of that asset. By collaborating, they effectively reduce their individual fixed capital needs. It's a really smart workaround.
So let's just take a quick breath and review what we've covered. We have the nature of business, scale of operations, choice of technique, technology upgradation, growth prospects, diversification, method of acquiring assets, and collaboration. I highly advise you to take a mental snapshot of this list, or literally pause and screenshot it right now, because these 8 points are absolute gold for your board exams.
Section 3, Working Capital and Formulas. So we've built the factory, now we shift gears. If fixed capital is the heavy machinery, working capital is the daily lifeblood that keeps the business running smoothly without any hiccups. It's the money you need for day-to-day activities. We're talking about buying raw materials for your inventory, paying your suppliers, handing out salaries to your staff, and just keeping cash in the register. Think of it like this. Fixed capital bought the giant manufacturing machine, but working capital pays the daily wage of the person who actually operates it. A healthy business has to strike a balance here. You don't want excessive cash just sitting idle, but you definitely don't want inadequate cash causing operations to grind to a halt. Now here are the vital formulas you absolutely need to memorize. Gross working capital is basically just your total investment in all your current assets combined. Stuff like cash, inventory, and receivables. But the really important one is net working capital, which equals your current assets minus your current liabilities. This formula is crucial because it reveals the true short-term financial strength of a business. Look, if your current liabilities are higher than your assets, you are in serious trouble. Moving on to Section 4, Factors Affecting Working Capital. Just like with fixed capital, the amount of daily cash a business needs isn't just a random guess. There are rules. Let's walk through the 5 key factors dictating this. Number 1, the nature of business. A local cash and carry sweet shop needs less working capital compared to a credit-heavy business. Number 2, the scale of operations. A massive FMCG giant like HUL clearly needs way more daily cash than your local soap maker. Number 3, the business cycle. During an economic boom, a company like Ultratech Cement will be producing and selling far more, requiring huge working capital. But during a depression, they need less. Number 4, seasonal factors. Manufacturers of room heaters will need extra working capital right before winter hits so they can ramp up their production. And finally, number 5, the production cycle. A company like L&T building a giant bridge has a very long production cycle. They need massive working capital to sustain themselves until that project is actually paid for. That's totally different from a biscuit manufacturer who makes and sells a product on the exact same day. And finally, Section 5, Final Revision. You guys have done wonderfully so far. Let's pull both halves of this capital equation together to see how this builds. Here is a side-by-side mind map summarizing everything we've covered today. On the left, we have fixed capital. It's for long-term assets, it builds the foundation of the business, and it's governed by those 8 key factors. On the right, working capital. It's for daily operations, measured by gross and net formulas, and governed by 5 specific factors. Again, I highly encourage you to pause the explainer right here and screenshot this. It is the absolute perfect cheat sheet to review the night before your test.
Before we wrap up, I want you to really think about this. Can a beautifully built, state-of-the-art factory ever actually survive without the daily financial fuel to run it? The answer, of course, is absolutely not. Fixed and working capital are 2 interconnected, completely reliant halves of business survival. You simply cannot have long-term success without mastering both of them.
And that wraps up our lesson on financial management. Thank you so much for watching this explainer. If this structured approach helped clear up these concepts for you, please hit that like button, share this with your classmates who might be stressing over their CBSE Business Studies exams, and subscribe to the ACE Archive for your next class. But before I go, I want to leave you with one final question. Ask yourself this. If a business only has enough money to secure one type of capital during a severe economic crisis, which one should they prioritize to avoid bankruptcy? Think about it, keep studying smart, and I will see you in the next lesson.